Hello and welcome. This is BQ Prime. I am Agam Vakil. Well, we've been looking at a lot of stocks which have been buzzing off trade, and very recently we also picked up a substantial amount of volumes data as far as one of your companies are concerned. This company specifically is into designing and manufacturing of processed material when it comes to the pharma and the chemical space. In fact, the pharmaceutical and the chemical industries are big clients of this specific company, HLE Glascoat. And to talk to us through the business outlook for that, we have executive directors Aalap Patel and Harsh Patel joining us to give us a better idea and a clearer picture of what holds for the company going forward. Gentlemen, good morning to both of you, and thanks for joining in. I'm going to start with Aalap. Thanks for joining in, Aalap. Let me just ask you about what the thinking was, firstly, in terms of promoters selling a little bit of the stake to DSP mutual fund. If I'm not mistaken, the stake comes to approximately 3.6%, 3.5%. Please do correct me if I'm wrong. What's the thought process here?
Yeah, hi. Good morning, Agam. First of all, thanks for having us. We had a transaction with DSP earlier this week. It has been our long-standing goal to have quality institutional investors in the company, and this transaction with DSP achieves exactly that goal. We very strongly believe that having a quality institutional investor, especially a long-only fund like DSP, amongst our shareholders, will attract more institutional investors and will eventually create depth in the market, which creates long-term value for our shareholders. And this exactly was the rationale. And as we have said before, this was also one of the rationales behind the enabling resolution that we had taken for a QIP earlier.
Right. And of course, besides institutional, interest, we also have a handful of marquee investors who are also invested in HLE Glascoat. But the other piece of news which came through for HLE Glascoat very recently was the acquisition of about 35% stake in Kinam Engineering. Harsh, can you actually take us through details? Now, from my understanding is that the agreement earlier in August entailed about 70%. If you could actually give us clarity on the completion of the entire deal, at the end of all the processes coming through, how much will you eventually hold in Kinam Engineering? And finally, what sort of value does this acquisition bring to HLE Glascoat?
Right. Good morning, Agam, and thank you for having me here. So yes, we have an agreement to acquire a 70% stake in Kinam Engineering Industries as of now. So this acquisition was anyway supposed to take place in two stages. The first stage of acquisition of 35.56% of shares was completed for a cash consideration. The second stage, which entails basically issue of shares to the sellers, will happen over the next 8 to 10 months. This will happen through a scheme which has been approved by NCLT, and of course requires some regulatory approvals and processes to be followed. So from 8 to 10 months from now, we will hold a 70% stake in Kinam Engineering. Now, Kinam is the largest manufacturer of heat exchangers for the chemical and the pharmaceutical industry. So it also offers the widest range of products for these industries. There is no competitor who offers the full range and the amount of heat exchangers that Kinam offers. Kinam has grown very fast over the past few years, mainly because it has been providing technology solutions to the industry. So as of last year, Kinam's top line stood at 122 crore with an EBITDA margin of 25%. We expect Kinam to keep growing at about 20-25% for the next few years. Kinam also offers a lot of adjacency. So we have customers overlap to a very large extent, and we intend to bring in synergies from Kinam and from HLE Glascoat to further boost Kinam's business.
Okay, fair enough. So, Alap, then a follow-up question then, can we in some way estimate what sort of a revenue contribution Kinam would get you guys in F25? Because I'm sure that F24, a lot of that will be used in amalgamation of the company. Should you actually go ahead and execute and all the conditions be met here? In F25, how much would it be roughly? I'm not asking you for an exact overall number, but even in terms of percentage wise, if you could give me that. And I'm assuming that the margins, the EBITDA margins for Kinam Engineering are slightly higher than HLE Glascoat. What would it mean for margins as well for the amalgamated business overall?
Sure. So this year we are expecting the top line of Kinam to exceed 150 crores. And like Harsh said, we also expect the business to grow somewhere between the 20-25% mark for the couple of years. So that should give you a fair idea of what we are looking at in terms of the top line for Kinam. We expect to continue having EBITDA margins at Kinam in the low to mid 20s. And obviously, since that is slightly higher in terms of the margin, we expect margin than HLE. I think on a consolidated basis, we expect the India margins to be somewhere in the 16 to 18% range.
Okay, fair enough. Then Harsh, let's talk about the amalgamated entity. One, I want an idea about whether or not there will be additional debt which will come in through as far as the consolidated entity is concerned. And going forward as well, if you just talk about in organic terms, if you keep Kinam aside, can you give us an idea about, based on the kind of order book that you have, can you give us an idea about growth going forward, if not for the first year, then at least for the next 2 to 3 years?
Right. So for the Kinam acquisition, we have taken on a debt of around 80 crore on the books. While that debt has been taken on, we are still maintaining debt to EBITDA, very healthy debt to EBITDA ratio between 0.8 and 1.25. So we'll continue maintaining that. As far as your question, sorry, what was your second question? Can you?
On an amalgamated basis from F24, F25, what would your revenue growth run rate look like?
Right. So the revenue growth rate, I think we will continue to keep growing between 15 and 20% for the coming years, okay. And continue to maintain margins on the India level between 16 to 18% on a consolidated basis. That's the outlook right now.
Okay, fair enough. So, well, I'm going to shift focus to your order book, and from the Q1 FY24, investor update, I saw that about a third of your revenues come from reactors, another third from ENFD, and then of course tanks, ENF, and others contribute to another third. Aalap, is this ratio likely to change going forward based on the kind of orders that you guys are pinning for, or do you expect this order book to remain the same largely over the next 1 or 2 years?
So I think the order book split is likely to remain more or less the same. It would change by a few percentage points here or there, depending on what kind of projects we see coming. But largely, I think we should maintain the same ratio.
Right. So Aalap, then the same question with respect to your industry breakup as well. Where are you seeing more order flows come through? Is it in the pharma space or is it in the specialty chemical space? Pardon me. The reason why I ask is that we're seeing a little bit of slowdown in capex in the specialty chemical space, at least this year. And a lot of that has not happened. A lot of that has, of course, taken place in the previous couple of years. So do you see an increase or decrease? Because at the moment, I'm seeing well over 40% coming in from the specialty chemical space. And of course, API and pharma contributing to another third. If you could just give me a broad outlook here as well.
Sure. So historically, our order book has been quite evenly split between the chemicals. So when I say chemicals, it includes specialty, agro, fine chemicals, intermediates. So all of the chemical industries and the API, right? However, for the last couple of years, since the specialty and agrochemical sectors were seeing quite a boom, the ratio was slightly more skewed towards the specialty and agro business. So what we are seeing now is that the pharma customers are coming back online. A lot of projects and inquiries that we are seeing from our pharma customers. And so the ratio is now coming back to what it historically has been. So it's coming back closer to what it has been, what it has always been for us. So which is somewhat like an even split between chemicals and pharma.
Right. Okay. Harsh, in that case, any planned capital expenditure, and do you foresee expansion plans going forward, maybe in the next year? And it could even be brownfield expansion. I'm not even talking about greenfield expansion, but anything that you can give us color on moving into the next financial year?
Sure. See, we just completed the expansion of our filtration and drying works, which is in Maroli last year. So that was almost about 30% addition of capacity there. Last year, we also completed a greenfield project in Silvassa, which was part of the filtration and drying business, which was an investment of around roughly 50 crores. We also completed the small expansion at Anand for the glass line capacity for our assembly section. So right now, all the expansions that are needed for the next few years for India are over. So we are not looking at any major expansions. We also did a small expansion where we are developing a competence and an R&D center for the glassline business, because we are investing a lot in technology that will get completed this year. So all in all, we are all set to capture all the growth that is available, growth possibilities that are available for the next couple of years. However, for the long run, we need more capacity for the next 15 years. Hence, we have acquired a land parcel of around 40 acres just outside of Vadodara, very close to the plant where we manufacture glassline equipment. Currently plants are being drawn out to make investments. We will do phase-wise investments in that facility, in that land that we have purchased, as the demand comes in and as the requirement comes in.
Okay. A final question then, and this one's for you, Aalap. Going forward, at least for this specific year, that is FY24, where do you see most of your growth come through? Will it be in glassline equipment, filtration, or drying and other equipment?
So I think for both of our segments, the split, like I had said earlier, is expected to be more or less the same. So we see the growth coming in evenly. And like I had said earlier, depending on the kind of projects we see, the numbers might be slightly skewed, maybe on the filtration and drying side or on the glassline side. But like I had said, it depends really on the kind of projects that we are executing.
Sure. A final question for you as well, Harsh. If you could just give us a quick timelines on the execution of your current order book. If I'm not mistaken, India is at around 5 to 6 months. Can you also give us a color on all your projects from abroad?
Right. So as you rightly said, India order book is roughly 5 to 6 months, and that is a very healthy order book that we have. In Thaletech in Germany, we have an order book which is roughly about 10 months. So that is also a good visibility that we have, and we are continuing to book orders both in India and in Germany at the rate where this 5 months and 10 months are maintained.
Okay. Well, gentlemen, you guys have given us a lot of details, and investors, of course, will be happy to work with the expectations that you guys have from your business. Thank you so much for joining in and taking the time out and giving us a view and a color on the business. But for now, we are signing out, but there's more lined up. So stay tuned to BQ Prime, and we'll keep bringing you more.